The Commercial Real Estate Show is brought to you by Cone Resnick, forward-thinking advice to navigate business and financial issues. Visit ConeResnick.com. By BB&T, banking, business, and commercial real estate loans. Visit BB&T.com. And Bull Realty, when your business requires proven performance, visit BullRealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit FranceMediaInc.com. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related topics, check out our on-demand show podcasts. For example, we had a recent show on mixed-use developments in the new economy, and a show on how the tax changes of 2013 may affect the commercial real estate industry, and a show last week on the single-tenant net lease investment market. You can access the shows anytime on your smartphone or computer. Just visit iTunes or the show website, commercialrealestateshow.com. Well, today we're exploring investing in distressed real estate and notes. Please welcome my next guest, Ann Hambly, CEO with First Service Solutions. Founded in 2005, First Service Solutions is dedicated to serving as a borrower advocate for commercial mortgage-backed securities, or CMBS, loan issues. As a veteran CEO of leading commercial mortgage servicers, Ann has committed her career to utilize her understanding of the servicing process to work for borrowers. First Service Solutions has completed more than $8.5 billion in CMBS restructures and CMBS assumptions on behalf of their clients. Ann Hambly, welcome back to the Commercial Real Estate Show.
Thank you, Michael. It's a pleasure to be back.
Well, your last show was very informative. We had a lot of great comments from our listeners, and that show is still available on the show website. And today I'd like to ask you about investors and sellers that are into distressed properties. Should an owner who just wants to get out and sell to a new investor, should they market or list their property first, or should they work with an advocate to achieve a discounted payoff first and then go to the market?
Yeah, that's a great question. The good news is that to get out of a CMBS loan, since it's non-recourse, it's a little easier than breaking out of jail, but it's not totally easy. So although the loans are non-recourse, where the value of the property is less than the loan amount and the owner just wants to get out, the process really needs to be like a dual one. So while we serve, as you said before, as a borrower advocate, so while we as the borrower's advocate are settling on a price that the special servicer will accept for the property, which is a process all by itself, the borrower needs to go ahead and list the property for sale without a stated sales price, because he doesn't know what right now he can accept. What he's trying to do is figure out what the market will pay, and then the borrower and us have to stay completely connected so that both pieces come together at about the same time. But it's important to note that the special servicer won't take the sale risk. So the borrower's really getting a discounted payoff, and then just the way that he's funding the discounted payoff is through these sales proceeds. And we've had a few instances, actually, this is important to note, where the borrower was able to sell the property for an amount that was greater than he had to pay the loan off for. Now, that doesn't happen all the time, but it has happened, and that allowed him to put some money in his pocket at the sale.
Okay, so putting the property on the market doesn't jeopardize your position with trying to negotiate a discounted payoff with the CMBS servicer? No,
not at all. In fact, if anything, it supports it because it's helping to establish real market value.
Okay, and you're suggesting not put a price on the property, but just put it out unpriced and see who makes the best offer.
That's correct. And although people might think of it like a short sale, it kind of works that way. It's not, in that the special servicer is not signing up and agreeing to sale risk. They're not agreeing to just accept whatever the price is. So these are two parallel paths that have to be pursued, and obviously very, very coordinated.
Okay. And as an investor in that property, then you might have a situation where you're going under contract, but have a pretty large contingency on the seller's ability to negotiate that discounted payoff in a number that works for this deal to close, right?
Yeah, you really, I give the caution that you really almost can't sign a purchase and sale without having an approval from the special servicer for an amount, unless you're willing to take the risk on your own. Certainly not recommended. So once the borrower gets a real offer and needs to accept it or not, that's when he has to come back to us so that we can, in fact, very quickly determine whether or not that price is an acceptable price or greater, with a special servicer. So it really is a very coordinated dual effort.
Okay, so you would typically share that offer with the servicer rather than negotiate that as a separate item, that discounted payoff.
Oh, absolutely. They have to be very, very connected. Again, but very important to note, the special servicer's not signing up for that sale risk. So there's a chance that the discounted payoff process gets ahead of the sale process. Mm-hmm. So in other words, they agree to settle for a dollar amount, and they expect you to pay off in, call it 60 days, and you as a borrower are signing up for that. And so you may or may not have sold your property by then. And if you haven't, and you don't deliver on the discounted payoff amount, then you're in default. Well, they're probably in default to begin with. So I'm not suggesting they approach it lightly, but it really has to be a very coordinated effort. It is not an easy thing to get done.
Right. Well, that makes sense. And, since the best approach for the investor in this situation is to present a solution to the special servicers in tandem with the borrower, what should an investor say when approaching an owner if they're interested in buying their property, if they know the value is upside down on a CMBS financed property?
Well, Michael, you just hit the nail on the head about one really important thing, and that is that the investors that want to buy into a distressed property really need to be in connection with the borrower. I'll tell you, when defaults started occurring back in 2009, and for the next few years, most investors that wanted to buy a distressed commercial real estate property that had all these funds lined up at the special servicer shops in hope of getting the opportunity to buy a property. And that line was, I always say, 5 miles long, wrapped around the whole city, and it didn't result in much satisfaction. So what we determined, and I think most people have finally recognized, is that in order to put your money to work, if you're a distressed real estate fund or a single investor, to put your money to work, you really need to work with an owner, and then you're going to essentially go through the process that I described on your last a minute ago, but it has to be in tandem with the borrower.
So if the investor is approaching an owner with a CMBS mortgage and the seller maybe just doesn't understand the process, what strategies or what advice would you give to that investor or a broker upon approaching an existing seller in that situation? Should they give them a little information on how this works and hook them up with someone like you to help them understand the process?
Yeah, I think that's probably the best way to word it. Is they need to, let's say that I assume if you're an investor and you want a particular property, and you know that it's suffering, the best thing to do is find out who the owner is, approach them, and see if they're interested in working something out together. And you don't know what that's going to look like yet. That's the kind of odd part. And then assuming that borrower is somewhat open to, working something out, and I don't know why they wouldn't be, then the two people together, the current owner and the investor, would call me, and we'd talk through kind of what the solutions might be, what the options are, how to approach it. And every deal is going to be a little different, but that is the best way for an investor to get to a distressed property in today's market by far.
Yeah, that's a good point. And we've obviously done that service for investors and for existing owners. And one of the things that can happen there is a joint venture recapitalization where this new investor brings cash into the deal, and the existing owner or existing sponsor stays in and sometimes can keep the management and keep the leasing. And it looks like to the public there was no change at all. And we're going to get into some joint venture recapitalization deals when we get back from the break. So stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Cohn-Resnick, forward-thinking advice to navigate business and financial issues. Visit cohnresnick.com. By BB&T, banking, business, and commercial real estate loans. Visit bb&t.com. And Bull Realty, when your business requires proven performance, visit bullrealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Would you like an easy button to attract more visitors to your website? Well, you can now download a free widget providing your site visitors access to informative commercial real estate show videos and audio podcasts right on your website. Just visit commercialrealestateshow.com and look for the widget on the homepage. It's free and it works automatically. Well, today we're exploring investing in distressed real estate and notes. My guest is Ann Hambly with First Service Solutions. And Ann, before the break, we were discussing joint venture recapitalization deals where an investor comes in and provides the cash and the existing owner or sponsor kind of stays in the deal. Can you give us some examples of recapitalization deals that have worked well that way?
I sure can. One of the most common ways that I've seen investors come in and joint venture or recapitalize with the existing owner is in the form of an AB note bifurcation. And I think everyone's heard about those by this point, but let me just explain it in general. The loan is essentially right-sized to the value of the property today, and the remainder of the loan kind of goes in the form of a hope note, in a drawer. And in that instance, the special servicer will always require the borrower to put up a substantial new amount of money, kind of new skin in the game at the time of that restructure. And the new money can be used in many ways: tenant improvement, leasing commission reserve, a debt service coverage shortfall reserve. They can use it to pay down the A note. A lot of times the money is needed. It's needed to be held by the special servicer just to make sure the loan doesn't turn around and default again in 2 years. Now, the new money, finally, in the market over the last couple of years, this new money has been able to earn a decent preferred rate of return, and the new money always has, always to date, has had priority over the hope note. And the purpose in that structure really was for the very thing that you just asked about, which is where you've got an owner that has a property, the value is less than the loan amount, it requires new money. Nobody would put new money over an over-leveraged situation today. So it is a vehicle in which you can, right-size the debt today, allow new money to come in, and sort of incentivize the new money to come into the deal. One example, if I can just take 1 second, I want to give an example of a deal that I think was just the sort of a prime example of how this works at best. In this case, it was a retail center in California, $27 million loan, and it was originated in 2007, as almost all good bad loans were. And it matures in 2017. The special servicer agreed to an AB structure, and the value of the loan today, or the property today, was $12 million. So $27 million loan, $12 million A note, $15 million became the B note, or the hope note. There was $3 million of new money required to execute here, and that was because there was an estimated $3 million needed of tenant improvement leasing commissions over the next couple of years. Problem is the existing partnership and owners only had $1 million to contribute. And so they were stuck. They would have not been able to get this deal done. But a REIT came in, brought $2 million of the $3 million, allowed the partners to contribute the $1 million. They restructured the organizational ownership structure of the loan, the property. The REIT got 100% control of the property and the management. And so it was a win-win all the way around. There was no tax consequences for the current owner. They got to stay in. They definitely lost some stuff, but that is what a new investor would require. And so, it became a classic example of how this new money can step in and help sort of bail out, if you will, current owners where the property value is less than the debt.
Yeah, well, that's a great example, Ann, and that's something that we do every day is help put those kind of deals together. And another thing that we're doing a good bit of is selling notes. Will a special servicer sell a single loan to a third-party investor in the CMBS world?
Well, to answer that, it's important, first of all, to understand the difficult position the special servicer's in. I spent my career in their shoes, and I think that's what equips me to be a good borrower advocate. But let's get in their shoes for a minute. No matter what they decide, there's always going to be someone, especially other bondholders, that will question what they did and why they did it. So if they were to just sell a single note or a property to a third party without the borrower being involved, they certainly could be questioned about why they took the price they did. How did they really know that the borrower wouldn't have offered more or reinstated the loan? So the answer is really no. They don't typically sell one-off notes or properties to a single investor. And actually, again, back to how we started the whole segment here, the investor really needs to approach the special servicer with the borrower in their court.
Yeah, well, that makes sense. Well, Ann, thanks for joining us today. We sure appreciate your time.
Thank you. My pleasure. I appreciate being part of your show.
Well, thank you. And if you'd like more information from Ann, they have great information right on their website, and I'll give you that URL. It's 1stsss.com. Well, after a quick break, we'll talk to a leading attorney about some best practices and mistakes to avoid when investing in the distressed market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is made available by professionals at Cone Resnick, BB&T, France Media, and Bull Realty. For more information about these companies or to access additional show podcasts or videos, visit commercialrealestateshow.com.